Hey everybody, it's Adam here with the Adam Heaney Home Loan Team. I'm sitting with Wesley Shin of Gonzalez CPA.
Hello, Adam. Thank you very much for inviting me here.
Yeah, thank you for coming. You know, I get a ton of questions all the time from borrowers, would-be home buyers about the tax benefit of real estate, you know. And there are some questions that come up time and time again, which I'm pretty confident in my abilities to answer these questions for the most part, but I had asked you to come here today just so that you could give maybe a little bit more background color on any of those and sort of fill people in, because again, there are certain questions that come up time and again, and it's actually a really important part of understanding the home buying process, knowing what the tax benefit is, because it helps for the overall budgeting. So with that, again,
all right,
thanks for coming. And so tell me again, so Gonzalez CPA, tell us a little bit about your firm.
Okay. All right. Well, Gonzalez CPA, we've been in business for about 2 decades, almost 2 decades here. We service, a wide variety of individuals and small businesses, and yeah, definitely when it comes to home mortgage, interest deductions, anything that involves real estate, I mean, that is a huge part of what goes into the tax return, and especially like with the recent tax law changes in 2017 that do take place in effect like this year, it's very important to be up to date on changes in deductions and tax laws, because there definitely are some pretty major changes that we should all be aware of.
Cool. And so with that, I just want to hit some of the common questions that come up, and which the first one that I get oftentimes, again, dealing with first-time home buyers, and not even first-time home buyers always, but when it comes to the question of gifting money for a down payment. So what is the maximum gift allowed with no consequences in any given year?
Okay, so the limit for giving gifts without having to report these, to the IRS would be $15,000 per individual. So that actually did increase from $14,000 from 2017. So starting 2018, it'd be $15,000. So now that actually could be doubled to $30,000, because if you give a gift to a spouse, like a husband and wife, as like a joint gift, then that is considered to be 2 individuals. So you could bump that up to $30,000.
Oh, okay.
Yeah.
And what if they have children, and I suppose they could give the grandparents could give money, $15,000 to the children as well, and that be part of?
Well, actually, it only does apply to like a husband and wife, like a spouse, 2 spouses.
Okay.
For children, they're still subject to their individual like $15,000 gift limits.
Okay.
Yeah.
But let's say if you had a husband and wife and with 2 kids, they could give a grandparent, for instance, could give that family of 4 a total of $60,000 without any reporting of tax.
Yep, that is correct. So I mean, it would be $30,000 to the husband and wife, and then $15,000 to each kid.
Okay.
And that wouldn't be subject to any gift tax reporting requirements.
Okay. So what happens if they do exceed that amount?
Okay, so well, all they have to do is report those gifts on what is called a Form 709, a gift tax return. So there is no taxes that you do have to pay when you do file the return. It's simply reporting who you gave these gifts to and the value of these gifts. And yeah, there are no tax implications until the death of an individual, where then you hit estate tax limits, and that as of 2018 is about $5.6 million
Per individual?
Yes, exactly.
So like a little over 11 million for a couple. So,
Yep.
So in a situation where someone is giving in excess of that $15,000 per year, and the estate, that donor doesn't have more than, say, a $5.6 million estate, they don't have to worry about there being any kind of implication later on.
Yep, that is correct.
So it's, in a way, it's almost a non-issue.
Yeah, exactly. So really, the IRS just wants to know, where these gifts are going to, especially these like large amounts. And yeah, so if it's under $5.6 million in gifts that you've given for your entire lifetime, you don't really have anything to worry about.
Okay. Very good. How about on second homes? Is the mortgage interest and property tax still deductible on second homes?
So
if so, what's the limit?
Yep, so the short answer is yes. So like the mortgage interest deduction applies to your first and second home. And the limit basically is dependent on the the debt that's outstanding, the principal balance of the loan. So there was a change in that starts as of 2018 where you can deduct 100% of your first and second homes, like home acquisition loan, up to that if the debt is combined at $750,000 or less.
Okay.
So, and that is for new mortgages after December 16th, 2017. If the loan originated before that, then it's subject to the old limit of $1 million.
Okay.
Yeah. So now, like, if it does go over that $750,000 or $1 million limit, then your mortgage interest deduction does get prorated down, and that is according to a ratio of how much over that limit it is.
Okay.
So I'll kind of give you an example here. Let's say that you have two homes, and for easy purposes, one of them is it's $800,000 remaining on that loan, and the other one has $700,000. So that's a combined $1.5 million. So that is double the $750,000 limit. So therefore, you can only deduct half of the mortgage interest.
Okay.
So that is how the mortgage interest limit works.
Okay. And so then I presume that the banks will just continue to issue the 1098
Yep.
interest form like they normally do, but then as the CPA, it'll be up to you to manually calculate whatever percentage over that, and then only go up to that amount.
Yep, that is correct.
Okay. Okay. Cool. So let's see then. How about when it comes to, we addressed the 750 loan amount maximum, but when it comes to the property tax limit, so it's $10,000 where it used to not be capped, but that's $10,000 for property taxes and state taxes?
Yeah, that is correct. So I would say that is one of the major changes that kind of came about from the 2017 tax law changes, in that yes, the property taxes plus any other taxes such as even like DMV registration tax, there are taxes there, that is included in there, along with real estate property taxes, that is capped at $10,000.
Wow.
So especially like in a state in California where we do pay pretty relatively high state income taxes, already, for high income individuals, your state income taxes might already exceed that $10,000.
Okay, so
Yeah.
some people might not even have been getting the benefit of that property tax anyway, because they're already paying high state tax.
Yeah, that is correct.
But was there a limit before this year?
There actually wasn't.
Okay, so it's really really gonna have some fun times with the tax returns in 2018.
Yeah, so we'll just kind of see how the numbers work out. So there have been, part of the reason why some of these deductions were limited was to fund the overall decreases in tax rates and tax brackets. So I would say it's not a complete loss, but basically it does kind of take real estate taxes out of the equation when it comes to kind of planning for deductions.
Okay. So how about on a investment property? Is there any limit to the loan amount, interest, or property taxes that you can deduct on an investment property? Let's say it's a $1.5 million investment property somebody has.
Yep, so there is no limit to mortgage interest or real estate deductions when it comes to investment properties. So I guess we'll kind of think about two different types of investment properties. One in which you generate rental income, like continuous income from. So basically, mortgage interest and real estate taxes are just considered like any other expenses, like HOA fees, insurance, like supplies, things like that you would normally use to offset your rental income.
Okay.
So rental income or rental losses are subject to certain limitations based on your the rest of your income, but you don't have to worry about just mortgage interest and real estate by themselves being limited.
Okay.
And then the second thing is if there's property that's kind of being held, to eventually sell for profit. Same thing. Interest and real estate taxes are just part of really the basis of those properties when you do calculate the gains or losses.
Okay.
On the sale of those investment properties.
Got it.
Yeah.
Okay. So what about, how about just talk for a moment about closing costs, like what, on say a refinance versus a purchase, what closing costs are deductible, what closing costs are not deductible?
Okay, so once again, this does get split up between personal, residential and investment properties. So I'll start off with a refinances of residential properties. So for that, the only thing that can be deductible are points paid on the refinance of a residential property, and that does have to be amortized or aka split up over the life of the loan.
Okay.
So let's say refinance and it's a 15-year loan, then you have to divide out the points deductions over 15 years.
Okay, so you don't just get to deduct all your points in that year.
Exactly. So now when it comes to investment properties, you basically can deduct all closing costs, but it also it basically gets added to the basis of the property, and just like for residential points deductions, you have to depreciate or amortize those expenses over the life of the loan also.
Okay.
Yeah, so in neither case would you be able to take the full deduction on the year in which you refinanced.
Okay. So, and I don't think that anything changed with regard to the maximum amount of gain on the sale of one's primary residence.
Nope,
what is that? Those amounts?
So nothing changed when. So I guess you are mentioning the home sale exclusion clause. So this hasn't changed. So if you sell your primary residential home, you can exclude, if you are married, up to $500,000 on the gain of the sale of the property. If you are not married and you're single, then it's cut in half by $250,000.
Okay.
So there are qualifications to that. And the main one is that you have to have lived in it as your primary residence for at least the past 2 out of 5 years. And it is something that you can only take once every 5 years.
Okay.
Yes. So if you sell your primary residence for, let's say, $600,000, and you gain about $600,000 from that, then you could take $500,000 off of that if you're married, and basically your capital gain is just $100,000.
Okay.
Yeah.
And so, how about when it comes to second homes? Is there any exclusion on a second home, or do you have to pay gain on all the gain?
Okay,
Tax on all the gain for a
so
second home?
most likely you will have to pay tax on the full gain because of the clause which says that you have to have made it your primary home residence for at least 2 out of the past 5 years.
Got it.
So there could be a rare case in which you might be able to do that, but I'd say it's safe to assume that second homes would not qualify for that.
Okay. Okay. And then so then on an investment property, when you're selling an investment property, what is the tax rate on the sale of an investment property? So a long-term gain?
Yeah, exactly. So it's kind of considered to be just like the same. It's basically a capital gain, so it's subject to either short-term or long-term rates. So if it was property that was held for over a year, then it would be subject to the 15% reduced capital gains rate.
Okay.
Although if you are in the top 35, well now it's the top 35 or 37% bracket, then that does go up to 20%.
Okay.
And also just as a disclaimer, for California, it does not have their own separate capital gains rates, so it just kind of is considered the same as the rest of your income.
Okay. Okay.
Yep.
And then so this is something that kind of more of my clients is becoming an issue for them, or something they could take advantage of. Not an issue, a good thing actually. Proposition 60 and Proposition 90, and for people who may not know, this is the ability to basically take the property tax basis that someone has had on a home that they've owned for several years, and basically make it portable over to a new residence they may purchase. So for instance, if someone has lived in a home for 10, 15, 20 years, and maybe now they want to downsize, but when they bought that home 10, 15, 20 years ago, obviously the prices were a lot lower and their tax basis is lower. So one of the things that makes it more challenging, especially if they're moving into retirement years, is weighing downsizing the home yet going up in tax basis. So what Proposition 60 does is, if it's within the same county, you can keep your same tax basis up to a certain point, I believe.
Right.
And if it's Proposition 90, it just allows you to go from one county to another and make it portable with you that way. So the hitch in this is, as I understand it, is the purchase price of the new home cannot be well, how much more than the sale of the home they just sold, or can it be a little bit over the home they just sold, and if so, by how much?
All right, so it kind of depends on timing. So if you purchase your new home, you know, like what pretty much before you sold your old home, then it does have to be the value of the new home must be equal to or less than the current market value of the home that you sold.
Okay.
All right, so now if it's 1 year out, so let's say you purchased your new home 1 year after you sold your old home, then the value of the new home can be 105% of the value of the old home.
Okay.
And then finally, if it's 2 years, then that percentage does extend to 110%.
Okay.
Yeah.
So 105% within the
1
first
year, and then
Okay.
110 within 2 years.
Got it. Okay.
Yeah.
Okay. Good to know. And then, so what would you say is kind of wrap up here is the best time of year to consult with your CPA about, you know, real estate taxes and just maybe your taxes in general. I mean, is it best to save it for March 31st?
Absolutely
Don't
not.
you love it
Yeah.
when they do that?
Yeah. So I mean, by the time you wait, the year's over and you can't really do anything. I would say that if you are thinking about selling or purchasing your home, that is probably the best time to try to consult with your CPA, so that you can you make decisions based on the potential tax effects. So really, as soon as possible.
As soon as possible. Okay. Yeah. And just even you kind of throughout the year, just keeping your CPA abreast of what your plans are and stuff.
Yeah, that's correct. Because one of the things about filing taxes is that by the time you file taxes, the previous year, I mean, it's over and there's nothing really you can do to make any changes or strategize around it. You just kind of file your taxes and see how the taxes come out. But you know, if you do talk to your CPA throughout the year, especially before you decide to make any major decisions, then you can definitely come out ahead to at least anticipate taxes and also possibly make some decisions to lower your taxes.
Okay.
Yeah.
Very cool. All right, one more question for you.
Okay.
A stumper question.
Oh, yeah, I was
This
prepared for that.
For our favorite bean counter.
Yeah. Yeah.
How many coffee beans in the California mug?
Oh wow! All right. Well, I don't have my ruler out here. Well, I mean, like, I guess, let's see. I would say let's say about 1,500. Yeah.
I think 1,500 is a pretty good guess.
Yeah.
I'm gonna get back to you on that because I don't really know. I got to about 100, and I'm like, I'm gonna have to continue this task later.
All right. Well, hey, you know, if you want me to count these, I'm an accountant. You know.
That's kind of no joke. Wesley, when I first went with Wesley, pardon me, he just said how much he loves that aspect of the job of being a bean counter and just loves crunching these numbers. He's been a great go-to person for me when I've had questions like this that have popped up. So if you have questions related to this stuff or other tax-related questions, reach out to me, reach out to Wesley, and be happy to help you guys plan as much as possible. And Wesley, thanks again for coming here today. I appreciate you being here.
Yeah, and thank you very much, Adam, for inviting me.
You bet.
Yeah.
All right. See you guys.